Okay, guys. So welcome to lesson 4. Lesson 4. We're moving pretty quickly now. So yeah, lesson 4 is going to be key levels and liquidity. So this is very important to our strategy. So we need to know where we are in the market. What key levels are we at? Have we taken any liquidity? These two things are some of the most important and key. It says it in the word key levels. So it's key. It's fucking key. So we need to make sure we have these locked in. So when I talk about liquidity, it's hard to draw it out now because we actually need to show it on the chart. So when I talk about liquidity is it's literally above all highs and all lows. So look, there is liquidity. Let me get this tool out. So there's liquidity. Oh my god, one sec. So there's liquidity here. There's liquidity here. Every wick there is liquidity. Yeah. So all these highs, all these lows, that is levels of liquidity where market is being drawn to take money off the markets, take out sellers, take out buyers, and then normally reverse and go in the opposite direction. Actually, there is actually a really good example up here. So if we just zoom in here, let's see if it's better on the 1 hour. Yeah, it works. But you can see it on both time frames here. But so here is a very good example. So we're in this uptrend. We're pushing up, and you can see here, this is a liquidity area because we have two equal lows here. So when you get an equal low, two levels that are pretty equal to each other, and then something like this happens, wicks down, takes out those two lows, and then reverses to the other side. That is liquidity being taken from the downside to fuel the move to the upside. So this is what we're talking about when we're looking for liquidity. And then here is another example. So we're at the highs. Price impulse is upside. So impulse is upside. It takes out these highs, and then it quickly reverses, breaks structure to the downside, and then it continues our down move. So this is a very key liquidity area that we need to keep our eyes out for. And the same thing happens here. Yeah. So we're in this consolidation market. So if you remember from I can't remember what video it was, but we was talking about different styles of market. It actually might have been the last video, market structure video. We're consolidating here. And then the good thing about this one is we know we're in a downtrend because we have broke this low here, so we're now in the downtrend. We are looking for short positions, but we start consolidating, and then, like I said, the good thing about this one is that we take out the lows, then we impulse move to the upside. We take out the highs, and then we flip again and take out. So we take both sides of liquidity from this ranging market. So when a market is ranging in that box area, we have liquidity above and liquidity below. And in this case, it took out the lows, went up, took out the highs, and then continued that downward move to the downside. So that's liquidity. So liquidity is literally above all highs and all lows. So even here, there is liquidity there. And that red line, if you watched the indicator video, I hope you did, you should have watched the indicator video and you have everything on your charts, you would have this red line here, and that is your previous daily high. So that is literally liquidity there, and that's why we have it marked out on the charts. As of down here, we have the daily lows, which has been swept out. So the previous daily lows have been taken. So that liquidity from yesterday has gone, and now a potential target, it's probably not going to happen, but a potential target would be to take out these daily highs. So we take liquidity to move to the next area of liquidity. So that is liquidity. And in this case here, we have liquidity here and liquidity here. So if we do find an entry model here, we could potentially move up. That would be a liquidity area. That would be a liquidity area. And then if both of them get taken out with very good displacement and a strong reaction, we could then see a pullback and then a push up to target those daily highs. So that's what liquidity is. Yeah, very simple. And then our key levels for this strategy is these fair value gaps. So we have fair value gaps in the market. Not sure if I've explained it, but we will go over it now. Let me get a thinner tool. So we have these gaps in the market. These are highlighted from the indicator once again to make life so easy. So we have these grey boxes and the blue boxes. The grey boxes are fair value gaps that they can get tested, but they haven't been disrespected. The blue fair value gaps are ones that have been disrespected. They both work in our favour, so it's good to have both of them on. Oh. So the grey ones, so a fair value gap is when there's a gap between 3 candles. And what I mean by that is, let me try and find something. I could just use this for an example, to be honest with you. So let's zoom in. So we've got this black candle. There is actually that's a fair value gap candle as well. So there's a candle here, this big candle, and then this other big candle. A fair value gap is created when there is a gap in the middle candle, meaning that this candle here and this top candle don't meet each other, i.e. the wicks or even the candle bodies or any part of them 2 candles. That's when, so if that candle there and this candle here don't touch, there is a gap in the market that needs to be filled or disrespected or rebalanced or whatever. So you'll see where there's not candles, where there's not fair value gaps being printed. These are ones they're not being printed because we've got a limit on the candles. There's loads, there's actually loads, so let's just, I'm trying to find something that's very clear. This one here, for example, so we've got a grey candle here, a grey candle here, then a black candle, but this grey candle meets this black candle, they cross paths, so there's no gap in the market. So if there was a gap, it's been filled, it's done. And then here you can see there's a gap here because why? This candle closed, this candle expanded to the downside, and then this third candle didn't pull up and then touch, didn't fill that gap. So there's a gap in the market that needs to be filled. These candles come in halfway, made just over halfway, and did fill it, but it's still a strong fair value gap because it's not been disrespected. And then it's come back up and retested that again. This blue candles is when a candle closes above it. So when blue fair value gaps. So when a fair value gap gets fully disrespected, it's actually called an inversion. So it's been inverted. Obviously, this candle here is the one that caused that. So it actually closed above. So it's been completely filled, and the candle was fully closed above that area, causing a inversion fair value gap. And then sometimes this can be an early signal of a reversal of a breaker structure, basically. So before this structure actually gets broken, this can be an early signal of a breaker structure. So yeah, that's literally it. And as you can see here, this is actually quite a little in-depth version of that. So we pull up, we pull down, we respect this fair value gap. It doesn't get inverted, that's why it's grey still. Then there's a fair value gap here, and then that gets inverted, and then we continue to the upside. Yeah. So what fair value gaps are as well, they can be used as basically like a support and resistance kind of level, just to keep it in a very simple term. So we can push down, and then a price can come back up, respect it, and then that level will hold as support or resistance, and it will push it to continue its move. So a lot of people can take buys or sells. Like this is a very good example. So let's just extend this fair value gap here. So there's a fair value gap here, prices broke down, it's pulled back into that fair value gap, and it's respecting that fair value gap, and then it continues its move to the downside. So a lot of people would literally take a sell off of that fair value gap. Some people have stops there, some people have stops there, and then some people have stops there, it doesn't matter, and then they target their 1 to 2 or 1 to 3 or whatever they want to target. That's basically what fair value gaps are used for, and it's still being respected now. So it's come back up, it's been respected, and then they're moving to the downside. So it's going to be interesting to see if this fair value gap here gets respected, what one's going to be stronger and hold more. But they're our key levels and our liquidity levels. So fair value gaps are our key levels. Liquidity is even more important in this strategy compared to fair value gaps and inversion fair value gaps. And then our last key levels, or I call them key levels, but our last important part to the strategy, it's like a fair value gap in the sense that it's used as support and resistance, but they are supply and demand zones. So supply and demand zones are literally the grey or black candle before the breaker structure. So in this sense, because we broke to the downside, we're looking for the last up candle that caused that breaker structure move. So this here would be our supply zone right there. It's the one, that's the last candle before the impulsive move that broke structure to the downside, and then a lot of the times price will come up, respect that supply zone, then react and continue its move to the downside. There will be many examples of these. This is a clear example. So we have a full demand zone here, and the reason why I use all the candles is because a demand zone and a supply zone will be all the candles. So if there's consecutive black candles before the big push upside that broke structure, then we use them consecutive candles. It could be hundreds of candles if they're all consecutive, but it needs to be the consecutive candles before the main move to the upside that caused the breaker structure. And what makes this demand zone stronger is that it also took out liquidity from these lows. So it took all that liquidity, pushed up, broke structure. This is a very strong demand zone that needs to be retested and respected for orders to push the market back to the upside. And then what happens here, we push down, we take out liquidity, we respect that demand zone, and then we pull away. And a lot of supply and demand zone traders will take a buy position from this supply zone, from this demand zone, and then they will target their 1 to 2 or 1 to 3 or whatever they want to target. And in this case, it wouldn't have hit take profit if you're just targeting a 1 to 2, but you get the point. So yeah, so demand zones are very good, very good. This is that's one of my favorite entry models, one of my favorite concepts to be keeping an eye on. Fair value gaps, like I said, are very good as well, because we had fair value gaps line up with the demand zone here, and then liquidity is another key level. And then, like I said, our other key levels are our previous daily highs, our previous daily lows, and I believe that is it. So yeah, the key levels, fair value gaps, supply and demand zones are what we're looking for, and our fair value gaps. And like I said, we can constantly see liquidity sweeps. So liquidity sweep, break to the downside, push back up. We don't actually respect that fair value gap, but we continue our move to the downside, and then we break structure here, then we push up, we respect that fair value gap, and then we continue to the downside. So it happens over and over again, but this is what we want to see all the time. So all you got to do is just keep an eye out when you're on the charts, keep an eye out for these supply and demand zones. Going into the higher time frame, we just need to, I didn't realise I had all that drawn on there, but we have to just keep an eye on where we are in the markets. So yeah, if we're in a downtrend, then we want to see price to pull above the 50% of the range. This is another key area that we're looking for. So if we're in a downtrend, we want the price to pull back above the 50% of that range before we start looking for short positions. Once we get to that 50%, like for this example here, we see a black candle here, it wicks up, we can start looking now. We want, as soon as it's been touched at 50% or we're close to it or whatever, that's when we can start being active and on the markets looking for those short positions. And what we want to see, preferably, is fair value gaps or supply and demand zones get respected. And then once we come into those key levels, i.e. for this example, we actually tap into this fair value gap. We tap into that fair value gap, then we can move lower into our time frames, and that's when we can look for a short position trade to continue our move to the downside, following and aligning ourselves with the higher time frame. So that's exactly what we do. I'm not going to go over the entry model yet, but you can see that entry model actually played out perfectly there. So we come into, this is putting the higher time frame together with the lower time frame. I did say I was going to do this later on in the videos, but we can go over it a little bit now, because we need to apply the key levels and the liquidity concepts to the strategy. So yeah, this is our fair value gap. Let me highlight that as our fair value gap. So this is our daily fair value gap. So it's a strong area. And then this is our supply and demand zone. So yeah, we need to make sure we're aware our colours of our boxes and stuff. So if you haven't done that yet, get your box tool, draw it out, and then you can double click on it and you can edit the style to how you like it. Obviously I'm not going to just go through all that, because you can just do that you want, as long as you've got the chart to how I have it looking or how you want it to look. Then match your boxes and your colours, and obviously edit them and add texts or whatever you need to do, and then save the template like I've got here. Look, buy, move, fair value gap, inverted fair value gap, sell, move, zone. Do that to how you like, and then it will help you just target what you need to target. So this is our supply and demand zone, our supply zone. This is our daily fair value gap. So both of them are reacting, I mean, both of them are based off the daily, right? So we've come up above the 50% of the daily. And this is why levels like this we will not care about too much. Like that supply zone there. We have supply zones here. Like here, for example, we have a fair value gap here. This is actually bang on the 50%, but so we would really keep an eye on this. But in this sense, we know what's happened, so we don't need to worry too much. So we push up, we push through. So we can delete all these, because we don't anything below the 50% anyway. With like these demand zones and supply zones, we don't need to mark them out because they're not important to us. We need to just mark out the ones above the 50%. So this one here, for example, this is a supply zone. So that's a supply zone. So we look for a reaction in there, and if we don't get a reaction, then we move to the next one. We've got one up here. You can just, in these kind of scenarios, you haven't got to use the full candles, because this one has already respected this one. So we can tighten it up to this one here. Price pulls up and it actually respects that beautifully, as well as pushing up and respecting that daily fair value gap. The higher the time frame on the demand zones, supply zones, fair value gaps, the higher the time frame, the stronger it is going to be. So really, preferably, you want to keep the eye on the fair value gap in this scenario, because there's nothing to... This supply zone is actually very good on the 4 hour, but the daily one will be stronger. So that's going to have more of a reaction area from it. It's not going to break through as easy as the 4 hour would. Like in this whole area here, we had multiple demand zones and supply zones get broken through until we finally tapped that daily. So the higher the time frame zone, i.e. supply and demand, fair value gaps and all that, liquidity, they are the stronger levels. So if there's nothing on the daily, nothing clear on the daily for demand zones and supply zones and all of that, then walk away, go to a lower time frame. But whatever the highest time frame is, that's the ones we want to use. So in this case, the highest time frames were the supply and demand zone and fair value gap on the daily. So that's what we get. And then we look for our reaction. And this is where liquidity comes into play. So once we start tapping into our areas of interest, i.e. the fair value gap, this is when we can come down to the lower time frames and we can start looking for our entry. Not going to get too deep into the entry, but I'm going to show you, because obviously we need to look at liquidity. And this is when we look for a liquidity sweep. So with the liquidity sweep, we actually need either a candle to close or just a wick to go above the area, the high. Either way, we need a strong movement away from that area once liquidity has been taken. So once liquidity has been taken, price can close, like I said, like a candle can close above that area. That is fine. So that is really a breaker structure until this happens. So this is breaker structure at the minute. But then once we get an impulsive move to the downside and we cause a market structure shift, because if you remember from the market structure course, part of the course, we're in an uptrend here, we shift, we break structure. Now we have confirmed we are moving from a bullish trend, which is here, to now a bearish trend, which is here. We have now aligned with our higher time frame, which is the daily. So we have now aligned, we've respected that fair value gap, and now we have market structure shifted to the downside. So now we know this is a liquidity sweep. So we can come here, we can mark that as a liquidity sweep. Now we have our liquidity sweep. We've shifted to the downside. And what else do we have? We have a huge fair value gap in here. Huge fair value gap in here that could be respected. This is when we draw our Fibonacci out. And then this is when we get our entry. So I will actually just go over this We are going to go into deep dive on the entry model, but this is basically the entry model. So on the higher time frame, we're looking for daily, for example. So if we want to make our entry model on the 1 hour, 4 hour, whatever, we need our daily range. We need to align with our daily range. So in this case here, we're bullish. So we're not aligned with our daily range. Here's our daily range blue line. So we're below the 50% here anyway. So we're not looking for short positions. We come above. Finally, this is obviously a new, that's a new week, so it's an opening gap. We fill that gap, we continue our move upside, so we're still bullish. And until our most recent low gets broken and we respect some sort of daily key level, i.e. the fair value gap or the demand zone, we do not look for shorts. We can't look for shorts in a bullish trend. Then we push up, we break structure to the upside, but then we tap into that fair value gap, which is on the daily. Then we have a strong push to the downside, which causes what? A market structure shift, telling us we have now gone from bullish to now bearish. We have a fair value gap, which we highlight. Key area, very key area. We need to see how we react in this area. We respect it. The wick, something else I didn't go over. To cause an inversion fair value gap, we need a candle to close past it. Just a wick doesn't matter. It's not an inversion. That's still a respect. So we have respected. And what else can you see in this whole area? Actually, that actually didn't close. That didn't even wick through it. So that respected. That respected that fair value gap. And what else did I talk about? Supply and demand zones. A supply and demand zone is a lot stronger when what? Liquidity has been taken. When that demand zone or supply zone takes liquidity. And what can you see right here? We have a strong supply zone. We have a strong supply zone sitting there. And why is that a strong supply zone? It's the 3 consecutive candles before the impulsive move to the downside, causing what? The market structure shift. So these 3 consecutive candles cause that liquidity to get taken. Then we quickly shift it down, causing the market structure shift, and we come back up. We respect the fair value gap, and we even respect the demand zone, supply zone, sorry, and then we push to the downside, giving us our 2R. If you're really looking for bigger swings, this is when you can, I don't recommend it, but this is when you can target the daily swing low. But like I said, I very rarely will recommend that, because price can come down and it can reverse to the upside to come to this demand zone. Because remember, this daily supply zone has not been respected yet. The fair value gap has, but this will need to be respected at some point. So price can come down, it can hit us at our 2R, and then it can flip to the upside, respect that supply zone, and then continue to the downside. So you can do this, but I do not recommend it. Wait until you get more confidence in the market before you start doing stuff like that. Because what I started to do at the end of my trading strategy, I would take 50% off here and then let the rest run down there. So yeah, bringing this video to a close, our main objective for this video was finding out what our key levels were and understanding liquidity. Liquidity is, like I said, we need to make sure we get either a close above or a wick above, and then we need to make sure there's a market structure shift after. And then obviously our key levels are our supply and demand zones and our fair value gaps. They are our key levels, and we need to make sure that we're using the range tool to find out where we are in the market. That's it. So we just need them 3 to 4 things. And then the last final thought on liquidity, I forgot to add, is when we're placing our trades and looking at our targets. Like, so for example, we'll just go up to the 4 hour. Like I said, once all highs and all lows hold liquidity, right? So as we're on our way up, we are taking liquidity to the upside. So we're taking liquidity here, we're taking liquidity here, we've taken liquidity here, we haven't taken liquidity here, but all of these highs here have been taken, all of these highs here have been taken. So most of the higher time frame liquidity is gone. Now, while we was working our way upside, what else was we building? We was building liquidity on the lows. So there's a lot more liquidity to the downside than there is to the upside, and that liquidity there also aligns with our bearish momentum on the daily time frame. So once we align here, what are our targets, or where can we expect price to move to? We can expect price to move to all these liquidity areas for targets. And that's exactly what happens. We push to the downside and take out all of those liquidity areas. So yeah, I think I'm going to wrap it up from here. We've gone over quite a few things, so it's just keeping in mind the range that we're in, the daily range. Use the daily as a nice range. If the range is not clear on the daily, then move down to the 4 hour. And then make sure if you're looking for sells, we are above the 50%. Look for demand zones and fair value gaps within that range above the 50% if we're looking for sells, and you want to wait for price to come to those areas and respect those areas. And then we want to see liquidity sweeps, a shift in market sentiment, i.e. the market structure shifts down here, and then we want to look for that continuation to the downside to follow our overall idea, our overall higher time frame idea that aligns with our lower time frame sell bias. But we need to make sure that the internal range has aligned with that higher time frame range, which is the daily in this scenario. But we want to make sure liquidity's been swept. We want to see a strong displacement to the downside, breaking that structure, and then we want to see a return to our key areas and so on and so forth to take the shorts to the downside for our targets, which is 2R. 2R all the time, guys. 2R all the time. I will go over Fibonacci, but obviously today is just key levels, liquidity, fair value gaps, and the supply and demands. And then from next week, we'll continue our momentum in pushing forward. And this is actually a very good overall trade setup and plan, so we're probably going to be looking at this quite a lot. There is other trades I've marked out over time. Yeah, we can maybe go over some of these, but we'll just see how we get on. There was actually a trade on AUD USD that actually played out perfectly. This was from a video that I made last week, I think. I was marking all these out. This is from the swing strategy video that I made last week, but it was a very quick crash course type of thing. This is the full course for it. But yeah, I actually said about this. This was live when I was making the video about this playing out. Sorry, this playing out. We had the liquidity sweep here, the push down, break a structure, return to our Fibonacci, and we was actually live at these highs here. And I said we could potentially now push down to take profit, and that actually played out perfectly. So there is a clean example of the liquidity sweep, the push down, break a structure, return to a Fibonacci, stops at the highs, take profits at the lows, entries at the specific level to give us our 2R, and take profit got hit very cleanly. And yeah, that also includes a higher time frame scenario where we've pushed up, we've broke structure on the daily, we are now higher the range. If we're looking at range from here to here, we're at the higher range, so we're looking for short positions to come below the 50% to continue our move up. So it's okay to sell up here, but it's not okay to sell down here. So down here we want to look for buys. Up here, when we've broke structure, we want to look for sells. And that's how we stay consistent in the market. But that is me going too deep into things. And yeah, I'm going to wrap this video up, like I've said a few times now. This is going to be an area that we're going to look at most of the time because it is pretty much a perfect trading scenario for this course. So we will be looking at this and going over this plenty of times. There's a lot of liquidity, there's a lot of fair value gaps, there's a lot of movement for us to work with. So that is the key areas done, and I'll see you guys in the next one.